Something big just happened at Palantir, and it's caught Wall Street's attention. The company posted a 33% GAAP operating margin, 18 cents EPS, and 63% year-over-year revenue growth, results that shocked even bullish analysts. CEO Alex Karp recently said critics are operating under deranged and self-destructive befuddlement. After seeing these numbers, he may have a point. This could be one of the most important buying moments Palantir investors have seen since the IPO. But to understand why, we need to go back to what Palantir actually does. What Palantir is, the enterprise nervous system. Palantir is not a typical SaaS tool. There are three core platforms: Gotham, Foundry, and AIP. Gotham is their government intelligence system used by defense, national security, and intelligence agencies. It merges massive data streams to detect threats, coordinate missions, track logistics, and make strategic decisions. Foundry is their enterprise operating system, used by private companies to connect supply chains, financial data, R&D, risk models, and more. Users can analyze operations in real time, from factories to customer data to logistics. AIP, the artificial intelligence platform, is the recent breakthrough. AIP lets companies and governments run advanced AI plus LLMs on their own secure private data. It's not just analytics. It enables scenario modeling, real-time decision automation, AI-driven workflows, and secure domain-specific LLMs. This platform triggered Palantir's newest wave of adoption, generating an entirely new wave of customers, faster deployment, shorter sales cycles, and rapidly expanding commercial revenue. Now let's get into the numbers, because they're each signal lights turning green. First, a GAAP profitability boom. 33% GAAP operating margin. For a company still early in its expansion stage, that is exceptional. Most high-growth software companies lose money for years. Palantir is printing cash. They posted 18 cents GAAP EPS, another major beat. This destroys the long-standing criticism that Palantir can't be profitable. Not only are they profitable, profit is scaling. Second, revenue growth surged plus 63%. This is hypergrowth territory. Even more shocking, management raised full-year 2025 revenue growth to 53% plus. That means growth is accelerating, not slowing. Third, the commercial business is exploding. For years, skeptics said Palantir was just a government contractor. That narrative is dead. AIP is driving massive commercial demand across automotive, energy, healthcare, banking, and manufacturing. Companies are adopting AIP because it delivers real ROI fast. Fourth, Palantir's Rule of 40 score is 114%. The Rule of 40 measures company health. Revenue growth plus profit margin greater than or equal to 40% equals very good. Palantir hit 114%. That's not just good, that's elite. Only a handful of software companies in history have reached that level. This combination of hypergrowth plus high profitability is extremely rare, and a big reason Wall Street is paying attention. After this incredible earnings report, many investors asked, so why didn't the stock immediately jump 50%? The answer: the market is still using old models to value a new Palantir. Wall Street hasn't caught up yet, and that lag is your opportunity. Reason number one: commercial shift equals true scale. The biggest knock on Palantir was its dependence on government contracts. Not anymore. Commercial growth is now the primary engine. AIP deployments take weeks instead of years, unlocking explosive scale. This is what turns Palantir into a true software giant. Reason number two: the AIP flywheel. AIP easy onboarding, real ROI, more customers, more data, better AI, faster adoption, more revenue. This is exactly how AWS, NVIDIA, and Snowflake built empires. AIP is now Palantir's growth engine, and it's only getting faster. Reason number three: valuation critics are behind the curve. Traditional valuation metrics don't work when a company is in hypergrowth and hyperprofit mode. Like Amazon, Tesla, and NVIDIA, transformative companies always look expensive early. Then people complain they missed the dip. The market hasn't priced AIP's true long-term potential yet. Reason number four: risk of not owning may be higher. With rising margins, accelerating growth, strong balance sheet, and government plus commercial dominance, The risk is no longer can they execute. They're already doing it. The real risk is sitting on the sidelines. So what sets Palantir apart from its competitors? First, AIP is not a database product. Snowflake equals storage, Datadog equals monitoring, C3.ai equals branding. Palantir equals decision-making infrastructure. And now, AI automation. Palantir operates at the core of enterprise operations, not just data storage or analytics. Second, they have real-world case studies. Ferrari faster development plus optimized manufacturing. NHS faster medical logistics plus resource allocation. U.S. defense mission-critical operations. These are high-stakes environments with real results, not trial projects. Third, the risks to consider. No stock is risk-free. Highly volatile, regulatory oversight may increase, and tech competition is evolving. But none of these outweigh Palantir's execution strength plus growing dominance. Fourth, the long-term outlook. If Palantir continues 50% revenue growth and 30% GAAP margin, then its long-term valuation could be dramatically higher. Analysts currently see $35 to $45 over 12 to 18 months. But longer term, if AIP continues its momentum, valuations above $60 to $80 plus are not unrealistic. Final take. Palantir is transforming from a specialized government contractor into the leading AI operating platform powering global enterprise and national security. With elite profitability, explosive commercial growth, AIP product momentum, raised guidance, and a rule of 40 score of 114%, this quarter marks a turning point. The market hasn't fully priced this in, and that hesitation is your opening. Are you buying? Holding? Let me know in the comments. Thanks for watching. See you next time.